AMFI, the Association of Mutual Funds in India, has also released mutual fund numbers for the month of March 2023. Of course, if you remember, this was the time of of the end of the financial year when debt mutual funds had stopped becoming lucrative. And let's just run through some of the numbers that have come from AMFI as far as inflows and outflows into the mutual funds are concerned. So, inflows into equity mutual funds surged to a 12-month high in March. This, of course, was aided by investments in sectoral as well as thematic schemes. Net investments in equity as well as equity-linked schemes increased 31% over the previous month to 20,534 crore rupees in the month of March. That's the highest figure, incidentally, since March of 2022, with equity funds now recording inflow for 25 straight months. All equity mutual fund schemes recorded net inflows in March. Sectoral or thematic schemes saw the highest investments, followed by dividend yield small and mid-cap funds. Meanwhile, focused funds received the lowest inflows, followed of course by multi-cap funds. Now shifting focus from equity schemes to the debt mutual funds, and these of course were the critical funds that everybody was watching. Debt mutual funds, as expected, saw heavy outflow in March 2023. Now, last month, debt mutual funds reported an outflow of 56,884 crore rupees. That's the highest in 6 months. This, of course, also comes at a time when there is tinkering in the rates and safer instruments like debt are finding other avenues in fixed deposits and bonds. Now, in the calendar year 2023, the debt category has seen total outflows of over 81,000 crore rupees. Among the categories, liquid funds saw the highest outflow of nearly 57,000 crore rupees, followed by money market funds. Liquid funds are preferred by investors to park their money for short periods. They invest predominantly in high liquid money market instruments, debt securities of very short tenure, and hence provide high liquidity. According to AMFI, the outflow from liquid funds was expected, as this is normal treasury management at the end of the financial year. Companies need to pay advance tax, and interest rates, like I said, have peaked, so investors find it more attractive to invest in debt funds. Now, investments via SIPs, systematic investment plans, topped the chart at 14,000 crore rupees, and this is for the first time ever. SIP contribution last month came in at 14,276 crore rupees compared to 13,686 crore rupees in the month of February. Harsh Roongta joins us. Harsh, thank you so much for joining us here on Business Plus. Initial thoughts looking at AMFI data, Mr. Roongta, what do you see?
I think very clearly the mutual fund bandwagon clearly marches on, and correctly so. It is uh, the mutual funds have something for every investor. You want to invest in debt instruments, it will have debt mutual funds. You want to invest in alternates like gold, you would have gold index funds or gold ETFs. You want to invest in equity, of course, there are various categories of equity. Some of them you just mentioned. It can be cut by caps, it can be flexi caps, multi caps, large, mid, small, biggest. It can also have a lot of hybrids. So you can mix and match, and that can, do auto balancing on its own. I think this very clearly the mutual funds have got the fancy of the retail investor. A lot of regulations that have been brought in by SEBI has aided that. The campaign mutual fund Sahi Hai has aided that. And I think we are going to see much further growth from here on. And the most heartening thing among the barrage of information that you gave was that SIP number. That if
Yeah.
you see through, lows and highs, it has been steadily inching up. And that is pure retail money. I mean, it would not have non-individual investors there. I think that is a very, very heartening sign. 2 billion, $2 billion every month, predominantly in equity, although there will be some amount of debt there, but predominantly in equity and hybrid, I think is a huge counterweight to the fickle money that comes in from some of the foreign institutional investors. So I think they are in mutual funds are in a very good space. They cater to individual investors and institutional investors as well. But primarily, the primary market should be individual investors. And I think we are increasingly see that happen now.
Okay. Talk to us, Mr. Roongta, about the sentiment of investing in markets today, where we've seen that they've more or less been on a flat to maybe, a 1%, 2% sort of an incline. We haven't seen the kind of sharp graph that one was used to seeing on the Sensex and Nifty. And this in the context of higher interest rates on fixed deposits. How do you see that story panning out for retail investors? Do you think that they are still going to be bullish through SIPs or one-time investments into equity mutual funds at a time when banks are returning a decent enough dividend on their investments?
So I think it depends on what timeframes you are looking at. Okay.
Okay.
I think moment you zoom out and you see from a larger timeframes, then this increase in repo rates and bank fixed deposit rates. If your money is meant for the long term, then very, very clearly, fixed income, even though you may put it in debt mutual funds or whether in bank fixed deposits, very clearly that is not going to be enough to offset the impact of inflation and taxes. And I think the realization is very clear. Investors are looking at the long term, and it's borne out by the fact, as I mentioned, the most heartening figure for me is the increase and the steady increase in SIPs, the number of SIP accounts, and I wish they had also given the number of PAN there. They have given the number of accounts at 6.28
Yeah,
crores.
we
So
don't know the
on
number
an
of
average,
individual
uh,
investors there. Right.
absolutely.
So,
So I
but
think
Mr.
it's
Roongta, what
very
is
powerful.
happening? Yeah. So, what is happening globally right now? Also, of course, we see and we keep reading about and reporting on US possibly heading into recession. We've seen what has happened with the banking sector. Linked to that, of course, is India's IT sector, and we saw TCS yesterday. Infosys, my colleague Soyash was just talking about today, both missing their guidance. Now, that is bound to play out on markets as well over time. So how do we sort of ensure that the the kind of trust and the confidence that individual investors had in equity linked mutual funds continues? What is it that needs to be done to tell them that this is not a short term money making instrument, and this is an investment you need to make for the longer term?
So I think clearly that is something that the mutual fund investors have bought in, that a quarterly result or even an yearly result does not matter. Okay. I don't have the data right away, but the average holding period of a individual investor, and I think that's what we should focus on. Okay. The average holding period of an individual investor, my hypothesis is it would have gone up. I do not have the data right in hand for me to say that, and I think that's close to about 2.5, 3 years. Uh, that is not long term enough, according to me, but
Okay.
it's better than probably the non-individual investors where it is probably shorter. So I think the individual investors have finally understood something about how long-term investment works that probably the institutional investors should replicate.
Okay. Mr. Roongta, I also want to touch upon, a specific category in mutual funds, and two of them, in fact, if you'll permit me. One, of course, are the fund of funds that invest globally. And globally, we've seen that over the last 1 year, 1.5 years, they haven't given any positive returns. And the other category I want to touch upon are ESG funds, which again continue to be in question. So, for somebody who is and who's a citizen of India and making investments in equity, would you suggest that these two buckets, FOF and ESG, should be touched upon at all, or is that not worth diversifying into?
So I think all investments are a matter of asset allocation. I think even FOF can be in the context of domestic investments as well, but clearly you are mentioning it in the context of international
Yeah,
investments, as well as direct international, as well as funds that invest in international
in international
equities.
equities.
I think clearly, see, the market cap of India is about three point something of the overall global market cap.
Right,
Okay. If you are going to concentrate your entire allocation to something that constitutes 3% of the overall global market cap, I think that may not be a good way to do an asset allocation. So definitely for your long-term goals, you need to have a slice of international equity. Now, unfortunately, I think whichever route you choose to go for international equity, whether you use an LRS to send money out, now that will be slammed with a very heavy
taxes.
tax collected at source.
Yeah,
The FOFs and the international equity funds in India have been saddled with a tax structure that's not very friendly,
right,
and more upon, even after the tax structure is not friendly, the availability itself is right now under question because of the RBI limits having been reached by most of the funds. I
right.
think this is a category. I think we should allow Indian citizens to be able to invest overseas. After all, we are a global emerging power,
Absolutely.
and we definitely, part of our soft power is also, retail individuals, investing overseas. Indian tourists going overseas are welcome in every country in the world. You can see countries scramble to, you know, loosen their visa regulations for Indian tourists. We are among the highest spending tourists overseas. We look forward to the day when countries overseas come and woo Indian retail investors.
That's right.
Yes, we need investors. We need our investors to invest in India. But also, I think as a part of diversification, an individual citizen of India should be allowed to invest overseas as well.
Okay, one final question to you, Mr. Rungta, before I let you go this evening. Now, we've seen what has happened with debt mutual funds end of the financial year. So those individuals who were using debt mutual funds as a window to invest and get that asset allocation between equity and debt right, what should be their alternative today? Because the tax incentive they were getting through indexation is no longer applicable. So what, according to you, should be their investment strategy to cater to the debt category in their overall basket of investments? And present day today, any generic formula which may not be linked to a very specific goal, any generic formula of a debt equity and other asset split?
I think generic formulas are dangerous. So I would say that individuals should stick to first having goals and then,
Goal-based planning.
deciding their, absolutely. That's what we do for a living, and that is what we
Do people
advocate.
follow that, sir?
Uh,
Do people follow that? My apprehension with that has always been that hardly ever when I speak to somebody who wants to start an investment, and now you've got apps and you've got plethora of tools available for you to DIY your investments. Hardly ever have I come across any individual who really has a goal in mind. So, people who come to you for professional guidance, do they really come with a goal in sight?
See, everybody has a goal. The goal may be not stated or articulated clearly. The goal might be, I want to make the highest return, right?
Okay.
At least that is a goal for most individuals when they are doing do it yourself.
Right.
Our
So
role
for
is to ask them, okay, highest return, what will you do with the highest return? Okay. And that process of inquiry leads to, finding out the highest return for what. And then you obviously do trade-offs when
Right.
you high returns come with high risk. So, you take it, it's a journey, right?
Yeah.
People might be confusing an intermediate stop, high returns, with their final destination. And I
Right.
think it is the job of an advisor to make them focus on their final destination rather than the intermediate destination of high returns.
So, highest return being one of the top level goals, what is the ideal asset allocation in the absence of the tax incentives you got on debt mutual funds? The question I started with, in fact.
Okay, so I think very clearly I've always advocated that debt as a part of an hybrid, okay, where there is equity and there is a self-balancing debt. It's very powerful, okay, and within a mutual fund, it's extremely powerful because when equity becomes high in a hybrid fund, a balanced advantage fund, what does it do? It sells equity when equity markets are high, it buys equity when equity markets are low, and the adjusting is debt. And
Right.
depending on your level of risk and the goal and the tenure, you can decide what your ideal allocation in that is. The power of that hybrid is the fact that it is auto rebalancing, and which by the client doesn't have to do the balancing. The client is freed from the clutches of the greed and fear cycle that normally accompany rebalancing decisions.
Right. So I said that I wanted to that was my final question, but my colleague Soyash sitting with me doesn't want to let you go that easily. He's got a question for you as well, Mr. Roongta. Soyash.
Sure.
So there's always this big argument, between active management and passive management. And in fact, the data shows that index funds garnered net inflows of about 95,600 crores last fiscal, which was the highest among all mutual funds. And now with most active mutual funds failing to beat the benchmark, do you see the trend or at least passive funds taking limelight in the future?
So before I answer that question, I think one disclaimer, I'm a big advocate of passive funds. Okay. But you look at that figure with a little bit of pinch of salt, because I think those figures are distorted by that high number of employee provident fund organizations, the ETFs that they have with SBI mutual fund and UTI mutual fund. Having said that, I think clearly passive funds are a very, very powerful way to take a stake. And people think of index funds only in the context of equity. I think index funds in debt are even more powerful. And unfortunately, till the tax the tax issue diverted it, a fund of fund that self-balances between equity index and a debt index was even more powerful. But I'm sure the mutual funds will find that out. But to answer your question, I think both passive and active have a role. And that is when you do goal-based allocation, that is when that will become clear that you would have to have a core strategy, something that gives you returns equivalent to the market at obviously market risks, and for a certain portion, depending on how much resources you have, what's your comfort level, what's your risk taking ability, maybe you would be willing to take a higher risk in the quest for a higher return. And I think for that, there will be active. Within that, there will be categories. Should for large cap, should you look at, active or passive? For flexi cap, should you look at active or passive? But those are good debates to have. And I think both have a place everywhere in the world. And I think they will continue to have a place in India as well. Having said that, passive as a percentage of the overall mutual fund pie, individual mutual fund pie at least, is going to grow. On that, I don't think there is any question whatsoever.